Chapter 6 is Supply, Demand, and Government Policies. In this chapter, look for the answers to these questions. What are price ceilings and price floors? How do price ceilings and price floors affect market outcomes? How do taxes affect market outcomes? And how do the effects depend on whether the tax is imposed on the buyer or the seller? And what is the incidence of a tax? Examples of price controls are price ceilings or price floors. A price ceiling is a legal maximum on the price at which a good can be sold, such as rent control laws. A price floor is a legal minimum on the price at which a good can be sold, minimum wage laws. The government can make buyers or sellers pay a specific amount on each unit, and that's referred to, or those things are referred to as taxes. If we look at rent control, local ordinances that limit rent increases for some rental housing units, such as in New York and San Francisco, have had a positive impact over the past 3 decades on the amount and the quality of broadly affordable rental housing in cities that have used rent control. 95% of all economists disagree with this statement. So they're saying that rent control does not improve the amount in the quality of affordable rental housing. So let's graph this. If we have the market for apartments, so we're graphing supply and demand, the rental price and the quantity of apartments. At equilibrium with no price controls, the equilibrium price is 800 and the equilibrium quantity is 300. If there's a price ceiling that's set, if the price ceiling is above the equilibrium price, then the price ceiling would not be necessary. It would have no effect at all on the market outcome. If the price ceiling, however, is below the equilibrium price of $800, then this price ceiling would be binding. But look at the demand versus the supply. At a price ceiling of $500, the demand for apartments would be 400, but the supply of apartments would only be 250. So you would have a shortage. In the long run, supply and demand of rental apartments are more price elastic. So the shortage would get larger over time. So what's going to happen? Because of the shortage, sellers must ration the goods among buyers. Some rationing mechanisms could include long lines, and there actually could be discrimination according to the seller's bias. So rationing in these shortages are often unfair and inefficient. The goods do not necessarily go to the buyers who value them the most. Let's look at the market for unskilled labor. So on the vertical axis, we're looking at wages and then the quantity of unskilled workers. So equilibrium price without any price controls is $6. What happens if there's a price floor of $5? Well, this is below the equilibrium price of $6, so it would not be binding and it would have no effect on the market outcome. However, if the price floor is above equilibrium at $7.25, the $6 equilibrium wage would be illegal. The price floor would be binding and it would cause a surplus of workers. So in the labor market, supply refers to the supply of workers and the demand refers to the business demand for workers. So there would be a surplus of people willing to work for $7.25 an hour. Minimum wage laws do not affect highly skilled workers. they do affect teen workers. A 10% increase in the minimum wage raises teen unemployment by 1 to 3%. So here's another Ask the Experts. If the federal minimum wage is raised gradually to $15 per hour by the year 2020, the employment rate for low-wage U.S. workers will be substantially lower than it would be under the status quo. And you see there's more disagreement amongst economists. 29% disagree, 37% are uncertain, and 34% agree. Okay, here's your first active learning assignment for this unit. So what you're going to do is you're looking at the market for hotel rooms. And I want you to determine the effects of a $90 price ceiling, a $90 price floor, and a $120 price floor.